Ladies and gentlemen, welcome to the fourth episode in the series Inside Private Markets, brought to you by Old Mutual Alternative Investments. In the prior three episodes, we've been unpacking for you what private market investing is, what some of the pros and the cons are, and really trying to get down to the first principles around this asset opportunity. Today, I want to put aside the cons. I don't want to talk about the risks or the negative aspects of private market investing. I want to spend time talking about why this is a good asset opportunity for any investor, and in particular, pension funds who are not well allocated to private market investments. So I've chosen specifically today two people who have dedicated most of their careers to investing in the private markets. And I'm going to be asking them to specifically unpack what those opportunities or pros are for the asset opportunity. So first of all, the executive head of investments at Rand Mutual Assurance, or RMA, Thiru Pather. Thiru, welcome, and thank you for joining us.
Thanks, Leon.
And then with a more difficult title, so I'll have to read this one because it's a little bit longer, the Director of Private Equity Partnerships at Blue Earth Capital, David Moore. David, welcome.
Thanks, Leon. Thanks for having me.
So guys, you most of your careers have been in private equity or private markets. Can I start off by asking you what attracted you to this asset class? What is it that made you feel you wanted to dedicate your thinking to it? So Thiru, maybe I can start with you.
Thanks, Leon. I must admit that I kind of stumbled onto private markets as a career. So I'm a chartered accountant by qualification, started in a merchant bank as a project accountant, then moved on to corporate finance. And while I was at PwC Corporate Finance, an opportunity came up to join the PIC in their private equity division. And I think since joining, I haven't looked back. I've been in private markets ever since. I think for me, the interesting thing about it is the people aspect. So yes, there's all the numbers, the financials, etc. But focusing specifically on investing in funds, you've got to learn how to read people, how to assess people and their abilities, etc. And that for me has been the interesting part of it.
Okay, good. David, yourself, you've worked both South Africa and abroad in the field. So what attracted you and what is it that you love about it?
Yeah, thanks, Leon. I think, to be honest with you, I think a similar story to Thiru. I don't think it was necessarily intentional to begin with. I think when I started my career, there was a bit of mystery around it. As to the fact that you have to value it yourself, you have to get to grips with the nuts and bolts of companies and not rely on as much say transparency that you get with kind of listed kind of counters. And so that I would say that unknown attracted me initially to kind of dig a little bit deeper. And I started my career in the space at Rescura, doing valuation and due diligence work for pension fund clients that were looking to actually at that point begin the allocation journey in private markets. And so it was a role that enabled me both personally and professionally to begin that kind of demystification of the asset category. And that's how it began, and I haven't stopped since.
There's different ways of experiencing private markets. The one would be similar to the roles that you guys have been playing around selecting funds or assessing GPs who are making the underlying investments in the companies and allocating that capital. Or you're part of a GP and you're allocating the capital and you're working with the management and so on. Is it true to say that in private markets, regardless of which one you play in, which part of that value chain you play in, you actually get a bit closer to the action, to see the company, to see the growth, to see the development, to see the intended outcomes that are meant to come from it, where in the public space you're a little bit just further away, there's a price and you move on a bit.
Yeah,
Sorry,
I think
sorry.
I think that's right, Leon. So even as So I've been involved mainly on the fund manager side, so allocating to managers. But even as we kind of assess fund managers, we go and look at the portfolio companies they've invested in. We interview the management to kind of um, basically corroborate what the manager has said as being their thesis, has been their way of working, etc. Then we'll go and look at pipeline companies. So the manager will tell us, okay, we've got these attractive opportunities in the pipeline. When we're due diligencing, the manager will go and talk to this pipeline company management and just understand, how advanced things are. So even as an asset allocator, we still have a good level of exposure to the companies themselves.
David?
Yeah, I concur with everything Thiru said. I think, in your due diligence, whether you're a allocator and a fund manager selector or you're a GP, these are kind of long-term partnership mentality type investments. So you need to, you're partnering one with, if you're an allocator, the GP and that management team, and then two with the underlying management teams of the investee companies. So the human element and I need to get to know you, to trust you, to look you in the eye, to kind of know that you're going to be a custodian of my capital or my client's capital, and that you're going to do a good job and that you're aligned with me is, I think, the paramount to investing in an asset class which is inherently less liquid and takes a little more time to monetize. So you need to have that trust established and verified right at the beginning.
And the other interesting difference in the private market space is, and I'm not encouraging pension funds or individuals to do this, but you do have the opportunity often to co-invest along with the asset manager or GP, which requires you in your own right to then do a due diligence and take interest specifically in that underlying investment. And that's quite different to the public markets. I suppose you could do it, but you generally wouldn't do something like that. So at that point, that was my introduction in terms of where I want to get to today. So I'm going to do this a little bit different to a normal interview. I'm going to ask you to please help me make a list, a specific list of what are the good, what are the pros that we want to put on the table, and then let's unpack each one of those. So David, I'll start off with you. You can choose anyone whatsoever. Let's maybe put a list of 5 or 6 together if we can get that far. What would you say is the number one pro for private markets?
Yeah, the easy one, Leon, for me is that it's just you're spoiled for choice when you look at the private markets. So if you think of it, the analogy for me is going to the shops. If you want to go buy, if you buy groceries and you go to the corner store, that's kind of more indicative of what you have when it comes to the listed markets. Because in SA, for example, you have 300 counters maybe that you can choose from. If you want to invest in the private markets and you want to go grocery shopping, you go to like the mega store, because effectively the number of counters that you can choose from is much wider. And so for me, you have the opportunity to really cherry pick what you want. You can also look at different investment themes. You can kind of target really what you want because selection is just broader.
Okay, so let's come back to that and unpack some examples around that. There's one very famous one at the moment that we can specifically speak about, but we'll come back to the benefits of what that provides to investors. Thiru, on your side?
Yes, so maybe just going a bit more into the sector diversification. So I think, when you compare private markets to the JSE, for example, there's limited sector exposure on the JSE, but in private markets, you have exposure to attractive asset class such as infrastructure, SMEs, including the township economy, which I think.
Let me stop you there. Let me stop you because we're going to come to that. I want you to unpack that in a bit more detail once we've got the list, if that's okay. So David,
okay.
back to you. Can you add a third?
Yeah, sure. I think the next one that jumps to mind for me is influence and level of control and input that you have in the underlying investment by virtue of your manager, or if you are a manager. So kind of touching on the point we spoke about earlier around the fact that this is a long-term partnership asset class. Typically, you are very hands-on via your intermediary in the underlying, so you can shape and be part of shaping its destiny. Whereas If
Okay.
you're a stock picker on a listed exchange, you really don't have that same ability to influence.
Okay, so again, we'll come back and unpack that a little bit. Thiru, again on your side. You guys aren't good at making lists,
So,
eh?
oh, no. Yeah, we weren't sure about how you were. Anyway, so the next one I would put on the table is better access to capital, particularly during uncertain times. And we can use COVID as an example on that.
All right, good. I want to unpack that. Again, David.
I think maybe something a little bit more technical, and maybe something that we're going to touch on anyway, is inherent kind of inflation protection in the way that the asset class is designed and what it does give you, which is important, I think, of course, for many of your audience today.
Yeah, Thiru.
I'd say reduced portfolio volatility because you're not valuing on a daily basis.
Yep. Okay, David.
Another one that's close to my heart is you can be a lot more intentional when it comes to targeting outcomes like impact and ESG integration and embedding that in the underlyings. So you can really be double downing on, like, addressing key themes and key priorities for you as a stakeholder.
Okay. Thiru, the last one for you.
The last one I would say is the long-term nature of private markets, allowing the management team to actually see the growth strategy through rather than, the kind of day-to-day pressures that you have in a listed environment.
Okay, cool. Why has nobody said a risk premium?
Because we're true believers
I
already,
did have
Leon.
that. Yeah, that's like a given.
That's a given. If you're
And you
dabbling
said
in this
don't
asset
mention
class.
liquidity. You said don't
Okay.
mention liquidity. So
I'm
my
not
first point,
not saying what the premium's for. Okay.
my first point was the higher return potential. So
Okay, so let's start there if you don't mind, because I think it's fundamental that investors appreciate that in theory, okay, and largely in practice, you should achieve a better return from your private market. So, Thiru, why is that the case?
So I think in private markets, so the higher return potential stems from better access to information, which leads to a better ability to choose the unique top performing businesses in a category. So managers looking at private markets investments typically have an exclusivity period where they can go and really learn a lot about the business, the management, their ability, etc., which is unlike the listed environment where, you're kind of limited to research reports and limited engagements with management. So I think that information then allows the manager to assess the competitive advantage of the business and whether it is truly a winner.
So there's an information advantage in assessing the investments, but then from the investment itself, you raised it as the last point where we stopped, which was the long-term nature to see the strategy through. So from an underlying company perspective, so I'll allow you to comment on this one as well through. Why is that of benefit? I mean, it might seem obvious to you, but perhaps not to the audience.
Yeah, so I think the long-term nature is of benefit because there isn't this kind of day-to-day pressure of keeping the stock price up, keeping investors kind of interested on a daily basis, right? So I think here, with the long-term nature, there's a strategy that's agreed upfront. There are mechanisms put in place between the manager and the portfolio company management to grow the business. And this is tracked at quarterly board meetings, at more regular engagements. And so there really is that space to allow the portfolio company management to see the strategy all the way through to an attractive exit.
Okay. It always makes me think of, I think the average tenure of a CEO on the S&P 500 is something like 3 years or something like that. It's almost like the football leagues around the world. If you don't win in your first year, you bye-bye and you're out of there. I just don't understand how the world has become like that. Because there is something to be said. I mean, I've run businesses. If you don't have time to implement and execute on your strategy accordingly and get the market to come to you by making it come to you, you could miss out on so much that would have been successful simply because you pivoted too soon. So that's where I see that as being probably one of the biggest advantages of private markets. David, you spoke about being spoiled for choice, and I'm going to link it with the next one that Thiru raised, which is around sector diversification. So it's about different themes, different opportunities that perhaps you don't get through the listed market. So can you unpack that a little bit and give a few examples of that difference that you don't get through the JSE or the S&P or whatever?
Yeah, sure. Happy to. Like, I think it's quite simple, of course. Like, you've got 300 counters which are dispersed across multiple sectors, but not every sector is well covered. So, easy one in the South African context for a long period has been, if I want to be a big allocator to infrastructure and energy and be kind of doing the right thing there on the green economy kind of angle, but I can't do it via the JSE because I don't really have any counters to invest in. But you can do it via the private markets, and you can do it any which way you like. So you can invest in infrastructure debt, you could invest in equity in renewable energy developers, you could do, and you can attack that sector in multiple ways through the private markets, but you can't do that in the listed markets. Similarly, like even if you look at a sector like healthcare in South Africa, how many listed healthcare counters are there? There's 2 of scale, but there are probably 10 private groups that do healthcare in South Africa, that you could then allocate to in the private market. So that kind of keeps giving you a little bit of a flavor as to, like, yes, there's some representation or potentially often none in some asset categories in the listed markets, but in the private markets you've got all of them to choose from, and then you at the end of the day have to make an informed decision as to which horse to back.
A good example that I always think about, but I think they're actually listing now, is SpaceX. So you don't easily find that kind of exposure, and that was a private company. Yet people tend to also think of private markets as investing in smaller companies. That's not the case.
No, not at all. Like, I think some of the biggest companies in the world are actually unlisted, and they're unlisted for a reason because of some of the points you raised. Like, founders and CEOs don't want the noise of reporting, of being beholden to stakeholders that are short-term in nature, that don't want to back them through multiple cycles of markets are fickle and difficult, and they want capital allocation to be consistent and smooth and aligned to a strategy, and they don't want to be, having to report on my share price is up X% this year, whereas they have a long-term goal or vision that they want you to buy into. And so I think that's very, very much the reason why you see both big and small companies remaining unlisted, because of that very dynamic.
EBNet is proud to bring you top quality content from experts across the financial services industry in South Africa and internationally for free. Your support helps us in doing this. All we ask is that you subscribe to our channels by clicking the subscribe button below. Share this video with others you think will benefit from it, and give us thumbs up if you are enjoying the content. That way you help us help you. Thank you from the team at EBNet. For more great content, please visit www.ebnet.co.za.
So they're tending to remain unlisted for longer. And I remember back to, I'll give away my age now, sort of the late 90s, where there was the listings boom in South Africa. It was cool to list, but also you could make a quick buck and disappear quite easily, and that's not good in its own right. So some of the companies available from a private markets perspective can actually give you far more stability in terms of management, in terms of, like we said, seeing out the strategy and so on. And the point around diversification is it's not companies that you would naturally find exposure to in some cases through the listed indices. So it does actually help you manage your risk. So let's just unpack that a little bit, because I think the the one point that was made, the words that Thiru, you used was reduced portfolio volatility. So I'm assuming you mean total portfolio. So if I'm an investor, a pension fund, I've got X amount locally, offshore, listed, and now I've got this unlisted. By bringing unlisted into it, which sometimes people will say, well, that's a more risky investment, it actually helps you diversify your overall portfolio. Why is that the case?
So maybe just touching on the volatility, right? I think that's just more of an accounting and pricing issue where, on the public market side, you've got pricing that changes daily, right? But on the private market side, managers value their portfolios on a quarterly basis. And there's a lot of conservatism that goes into the process. So it's not very often that a manager will write up the investment in the first year or even the second year. And so when, you won't get those kind of daily swings and roundabouts and investor caution or concern around the portfolio and the performance.
So before you go on to talking about how that benefits a total portfolio, let's just unpack that a little bit for the audience. So you used the term the writing up of the investment. So you allocate capital, you then value it on a quarterly basis. It's inherently conservative. There will be a basis that gets followed. And as the business then grows and achieves certain things, you would then look at that and write up that investment according to, again, some basis. Is that correct? And can you add to that in any way?
Yeah, so that is correct, Leon. But I think typically the manager would need to see a consistent uptick in performance before they write up investments. And so you're not getting those swings and roundabouts that you would typically get on the stock exchange.
Okay, so then from a total portfolio perspective, can you just explain for the audience why bringing in something like that ultimately reduces your risk or your volatility within the fund?
So I think this comes back to David's point, right, in terms of the universe of investable opportunities in private markets. So I think bringing private markets into a portfolio helps diversify across sector and also across asset class, right? So in private markets, yes, there are lots of large businesses, but you can also get exposure to sectors like SMEs and venture capital, and areas that listed companies don't necessarily cover, which is the township economy. And I think that was valued at somewhere around 900 billion last year. Yeah, so I think you're just getting a broader exposure. And a lot of the times businesses that form part of a private markets portfolio tend to be counter-cyclical. They're generally businesses that are not reliant on GDP growth. They're generally the best in breed in their segment.
So, David, the US has just started a war with Israel attacking Iran. What's the difference between investing in the listed markets versus the unlisted or private markets when incidents like that happen? And they happen every now and then. It's an earthquake or a flood or a war or whatever it might be.
Yeah, look, I think there's a great case in point that we've all lived through. But when I was looking after a largely domestically focused South African private markets portfolio, and we had COVID, and everyone did a deep dive on their private market assets, and a big exposure that I was managing at that point was infrastructure. And COVID, you could see obviously stock markets were falling, and there was a huge amount of volatility within people's portfolios, people wanting to redeem capital. But wind farms, the turbines keep on turning, the sun keeps on shining, and those assets had very little or no impact from those sorts of market-based events. So from a portfolio perspective, very much, counter-cyclical, negatively correlated to what the conventional kind of hot money flows do in listed markets if you have assets like that in the private market space. Not to say that private markets are fully insulated, but because I think that would be, a stretch, because yields will blow out a little bit, and so there was some volatility, but not to the extent that you're seeing, the same magnitude on listed exchanges. So there's a degree of insulation by virtue of different types of assets in different sectors that behave differently in different parts of the cycle, and I think that's what you're adding.
And what's important about that is we're all subject to investor psychology. So as much as I've been doing this my whole life, I still look at my portfolio every day, and I've watched it every single day during the war, because I'm like, oh, what's going to, take place? Yeah, should I do something? Shouldn't I do something? I haven't. I've just stuck with it. So I've been a good boy. But if you think about a member of a pension fund, when they're seeing volatility coming through from the markets off the back of short-term uncontrollables, it can make them nervous. So this does help dampen that effect to a certain degree, because it's not as sensitive to those external unavoidables, if I could put it that way.
Agreed.
You mentioned inflation hedging or protection, or what was the term that you used? Inflation protection. Can you just explain that?
Yeah, look, I think each of the asset categories within private markets has a different degree of that built in. So the easiest one is things like infrastructure or private equity. Private equity, more often than not, you're investing in, as Thiru mentioned, category leading, high growth businesses. And by virtue of that, their revenue, their earnings are growing at well above inflation. And so then by valuing assets that are growing at that rate, you're typically going to get a performance-based outcome that exceeds an inflation kind of eroding kind of annual kind of eat into your return profile. Similarly, things like private debt and infrastructure have CPI and inflation built into their return profile. So, for example, in infrastructure assets typically have CPI linkages in their actual tariffs that they contract, and so it means that your return stream has that protection in it over the long term, which is critical to I think many members of the audience today around understanding what my assets will be worth and are they inflation protected in the long run. So many of those asset categories, or if not all of them to some degree, have that built into their return profiles.
Okay. You mentioned as well, but I'm going to ask Thiru to come in here. You mentioned the fact that you can also call it invest in the real economy and seek to achieve specific impact type outcomes that don't just produce a return or produce earnings, but ultimately also produce a good result that supports the community or supports the solving of the world's problems. So, Thiru, can you unpack what do we mean by that? What is impact investing, and why do we always associate it with private markets? Because surely you can also achieve impact in the listed markets.
Yeah, so Leon, I specifically associate impact with bringing services to the kind of greater population, right? So making key services accessible. So I think particularly in private markets, there is a focus on things like student accommodation, affordable housing, affordable education, affordable healthcare. And these are businesses that are performing very well. So they're making good returns, but they're doing it while delivering a service at a lower cost to the consumer. I think on the job front, in private markets, with it being a very growth-focused area, if you're going to get growth, I think you're automatically going to get job creation, unless you're in more of a tech type of environment where things are kind of scalable in a different way.
So that's what I mean about the real economy. There's I don't know if the word predominance is correct, but there's a lot more opportunities to invest in grassroots-ish type businesses that are either building factories or, having to employ people specifically, probably greater than, yes, certain sectors like tech, but in the listed markets, there's a more mature companies that are looking to generate efficiencies rather than always hire, if I could put it that way. So that's where that, call it impact from a social perspective, comes to the fore. But David, you've got the blue earth there behind you, so it must be important to you. So talk to me about the environment and impact, and if you can also perhaps just cast your mind to where South Africa is in terms of impact investing versus, call it, Europe and other areas where, from my experience, there's there are taxonomies, there's clear strategies that are being targeted that funds are investing in.
Yeah, 100%, Leon. Like I think this side of the pond, climate and social impact are key imperatives in many stakeholders' mindsets as to how they allocate. Pension funds, foundations, and the like are very much active in this space, and it's not even a nice to have now. It's much more of a intentional or intentionality driven allocation theme. So if I'm a pension fund or a stakeholder and I want to do impact investing, I will screen. There are dedicated impact managers out there now that are doing this, and there's a kind of a philosophy that you need to then prescribe to as to where you want to play on that impact spectrum. So I think you can be more concessional in your return expectations if you like, and more impact driven for impact outcomes, or you can be more commercially return focused to kind of to at the same time drive impact outcomes. But it's not even now a kind of a soft kind of notion. It's now measured like returns are measured. So if you're allocating to an asset, for example, as Thiru mentioned, serving the underserved at scale is a big theme in social impact in emerging markets, for example. Then you track your returns like you track your financials, but you track your impact just the same way. So you measure on an annual or semi-annual basis how many consumers have been served, or, how many loans have been extended, what the effective interest rate is, how many jobs have been created. It's now become much more of a science than you could say an art or a nice to have or a notion. And so I think that's where the mindset of impact investing has migrated to.
But it's also developed to be more intentional. So it's not just what did we happen to achieve at the end of it, but more we intend to create so many jobs. We intend to reduce greenhouse gas emissions by X, Y, and Z. And therefore, the term that I've learned is if it can't be measured, it can't be managed, becomes critical, because it's too easy to position the violin type music when speaking to people about investments. We need to get to a point where the outcomes are achieved, and I know that that's been an evolution globally where people have had to learn hard lessons along those lines.
100%. It becomes now legally binding and contractual on the underlying investee companies that prescribe or believe that they can achieve certain targets. So, if you're an allocator and you come in to company X or Y, you're setting goals for them. As you set financial performance goals, you're setting, goals around, transformation within the workforce, job creation targets, CO2 offset reduction targets. All of this becomes as important as kind of your profit margin expansion. And so if you're not a believer and you as a manager and a founder of a company are not aligned with these stakeholders, you'll be found out very quickly. And so, I think the intentionality piece is critical, as you mentioned. So it's intentionally looking for strong impact outcomes alongside strong commercial returns with no compromise.
So, Thiru, we live in a country here in South Africa where we've got massive unemployment, highest levels of inequality in the world. People are reliant on social grants, and those numbers are just continuously increasing. This is the place for impact investing. If ever you needed to try to find one, here is the place. We need the capital. We've got a lot that needs to be done, and the government has encouraged that by allowing for 45% in infrastructure, 15% in private equity, yet we're sitting with the average pension fund between 2 and 3%. Okay, now there's reasons for that in terms of the risks. We don't want to go there. Okay, we're not doing that today. But do you not see a world where this is going to evolve here in South Africa, where there will be greater intentionality, or at least there's business opportunities to actually start thinking about South Africa in that sense, to help encourage the capital? Because right now the labels of infrastructure, private equity, well, what is that? How do I do that? But if we can start packaging things in a way that the investor can go, okay, I understand the risk, I understand the return, and I understand the intent that's behind it, and there's measurement behind that, surely that will help us grow that picture. Given that we are now talking about impact investing, I thought now would be a good time just to take a little bit of a break and focus a bit on the concept of impact investing. Impact investing is so important for South Africa, given that we are having to develop the country ultimately for all of its citizens. Therefore, I definitely recommend that you keep in mind and consider impact private market investing as part of your overall portfolio structure. Not just does it help our economy, our country, but it also can produce exceptional returns for you and your members. Our sponsor, Old Mutual Alternative Investments, are active in the space of impact investing, one of the fastest growing forms of private market investing in South Africa. I now invite you to watch this short video on one of their initiatives called EduFund. Please enjoy.
My name is Kelly Joshua. I'm the head of education investing within Old Mutual Alternative Investments. Through its education funds, Old Mutual Alternative Investments aims to increase access to affordable quality education. By doing this, we provide greater opportunities to our youth. We can potentially end the cycle of poverty as well as stimulate economic growth. When assessing an opportunity, the performance of a school is highly dependent on the track record, experience, as well as composition of the operating team. It is this team's responsibility to ensure that the teachers, facilities, and systems all support quality education outcomes. It is this team's responsibility to ensure that the teachers, facilities, as well as systems all support the education and development of the child. So beyond pass rates and headline results, my team and I hope to build schools that support the holistic development of a child, which includes adequately preparing them for the future of work life as well as active citizenship. The fund's primary impact is the creation of affordable quality education facilities. Achieving our desired impact forms the foundation of any school business. So effectively, there's no trade-off between the two. If you do not provide a value proposition to a parent that is attractive and includes quality education, you're effectively going to struggle financially and the long-term sustainability of the school will be compromised. Since the fund's inception about more than 10 years ago, there have been so many lessons learned. Off the back of those experiences, we have made strategic shifts in the strategy of the fund to support improved financial as well as social impact outcomes. I'm excited about how this is going to evolve and the opportunity to create large-scale positive impact on society. The fund is incredibly proud of the matric results achieved this year. We've seen significant improvement of some of our historically struggling schools, and more than one school has finished top in the district. A special mention, however, has to be for Kamagelo Chabalala from Akudeo College, Kirkney. He was awarded the top learner in matric from an independent school in the country. And in Gauteng, he was the top learner in mathematics with a 99% pass rate. This is an exceptional outcome, and we will continue to support him in any way we can through his tertiary studies as well. We intend to keep up this positive momentum and ensure that our schools go from strength to strength.
Yeah, Leon, I think there has already been a lot of progress in terms of pension funds allocating to private markets. So the percentages are still low as in terms of the whole. But I think when I started in private markets in 2009, and David will probably have a similar experience, we could count maybe on one hand the number of pension funds who would readily invest in a private equity fund, right? So I think today the list of names who are invested in PE and infrastructure funds has increased by a lot. They're probably, it's probably tripled or more, right? And there's some names there that I hadn't come across before. I think the issue, though, with the numbers still being low is that people are overrating the liquidity issues in private markets, right? So you've got to look at the percentage of private markets in relation to the whole portfolio. And when you see how small it is in relation to the portfolio, the liquidity then becomes a bit of a non-event. So fully agree that there still is a lot more to do in terms of education, but there's definitely been progress over the last 2 decades.
So I think that is a very diplomatic answer, and well done. You articulated it fantastically. I'm going to be less articulate or diplomatic. I think the asset consultants need to get off their backsides and start advising customers properly, doing the research, not seeing it as extra cost. And how do we charge for it? If there's value, the customer will pay. But to cover the assets, to cover the opportunities, educate the customers, package things in a way that's going to help them make the investment and deal with the negatives. Every investment has a negative, and it needs to be understood and ultimately dealt with. So that if they want to shoot me, they can shoot me. But I really think it's their biggest opportunity to reinvent their own profession, kind of thing, especially when it comes to things like climate change and the complexities involved with that, and the different investment types for mitigation. I think it's fascinating. It's, to me, if I was an asset consultant, exactly what I would want to reinvent myself along the lines of. So, guys, our time is nearly up. Have we missed any pros? Is there anything else we should leave with the audience to say, guys, this is why private markets is a good opportunity for you? Not to throw everything in to the ring, but to have a decent exposure. It'll benefit your fund. It'll benefit your members, not just in terms of their retirement benefit, but the community and the country that they are ultimately part of. Is there anything we've missed?
I think one just to add is one point that I think brings it home, at least for me, when I'm allocating, when I was an allocator of pension fund capital, is the tangible benefit that is delivered to the members in essence. Because if you're allocating to things like affordable healthcare, affordable housing, affordable education, retirement accommodation, effectively you're building the assets and the future for your members, for your member base, because it's as simple as you, via private markets portfolio, build the retirement accommodation that your members retire into. It's as hands-on as that. And I think if you can articulate it and see the actual tangible benefit that you build a power plant that keeps your kids lights on, that's kind of why it, for me, is so compelling as an allocation for a pension fund.
Last word from your side?
So I think I'd like to just touch on the access to capital point, right? So I think in private markets, you're dealing with a group of investors who are flexible, who are practical, and who are solutionist. So a case in point was COVID, right? When COVID hit, LPs like David and myself, we got onto a forum and we discussed how we're going to help the managers get through this period. And we put in place, some solutions, for example, increasing their commitment period, etc., so that they can be successful in the long term. And by the same token, the managers then looked at each of their portfolios and said, how can we help you? So they put in place things like working capital facilities, kind of got into a room and strategized with the portfolio companies. And so that kind of flexible, nimble, solutionist nature, I think, is what makes private markets successful.
Okay, great. Well, guys, I want to thank you very much for coming on the show and sharing your wisdom and your insights with us. Just for the audience's sake, and I'm going to be a little bit vulnerable here, but EBNet are covering the SAFCA PE conference That's in Cape Town next week. So we'll be there listening to all the different talks, and we've got a podcast booth. So if anybody is there next week, please come around to the podcast booth and come introduce yourselves, and we'll do a little interview that we'll put out to our community. But the vulnerability that I'm going to share with you, and I'm not certain how the brain always works, but in this case, my brain didn't work so well. So when I saw it was the SAFCA PE conference, I almost booked myself a flight to Port Elizabeth. Thankfully, one of my colleagues pointed me in the right direction, so I will be in Cape Town next week for the conference. Guys, thank you so much. David, Thiru, thank you. I hope Thiru, I'll see you next week, and David, we will keep in touch. All the best.
Yeah.
Sounds good. Thanks, Leon.
Thanks, Leon.
Cheers, then.